Oh my god, did you hear the Pope died? Do you know what that means? It means you can bet on this.
Oh, come on! What's here? Bye!
There's $6.5 million of betting volume on this. Man, why are so many people betting on this?
How did gambling addictions become the rite of passage for college males? Are 19-year-olds all of a sudden statistical geniuses? Or are we enabling a generation of degenerate gamblers and watching the casino move to Wall Street?
Like, we can all agree it's crazy that people are betting on the next Pope, right? And I think I'm gonna be one of those people. I didn't know you could bet on that.
These are things you wouldn't ever even think to gamble on, yet there are millions and millions of dollars in bets being placed as we speak. But first, I think it's important to understand what we're even getting ourselves into, because technically speaking, this is anything but gambling.
Betting or selecting, I guess I shouldn't phrase it as betting. That's probably not how it's supposed to be phrased.
Instead, it's an algorithmic trading of event contingent derivative contracts. But what does that even mean? In order to understand, we should take a look at the difference between gambling and prediction markets, because legally speaking, they are very different. For example, when you're placing a bet on a football game, you are betting directly against the house. So no matter what happens, the house will always make money in the long run, regardless of the outcome of the game. In a truly fair bet, like gambling on the outcome of a coin flip, the odds would be considered even money or plus 100, meaning you bet $100 to win $100. The implied probability for each side is 50%, which adds up to 100% in total. However, when a sportsbook or the house gets involved, the odds are set so that the implied probability for all outcomes adds up to more than 100%. That extra percent is the house's built-in commission for taking your trade, or action as they call it, which means the house's job is not to correctly predict the winner, but instead to set the odds in a way that attracts roughly equal amounts of money on both sides. And when the game ends, the house uses the money lost by one group of bettors to pay the winning group, and they keep the VIG as their guaranteed profit on the total amount wagered. This can be a little difficult to understand, so let's break it down with some numbers. Say you and I are watching the Vikings versus the Chargers this week. Right now, the sportsbooks have the over-under on the total number of points scored to be 44.5, which means that you can either bet that there will be less than 44.5 total points scored or more by the end of the game. You can see here that the odds of that is -110 for both sides of the bet. So if you bet they will score over 44.5 total points, and I bet that they will score less than that, we would each risk $110 for the potential profit of $100. Let's say the final score at the end of the game ends up being 28-21, which leaves us with a total of 49 points scored, meaning you win the bet and the house will pay you $210. That includes the $110 you placed originally and the $100 in profit, but the house keeps the $10 from my bet as their profit. So I end up walking away with nothing, and that is the most important piece to this whole equation. No matter who wins or loses, the house always walks away with a profit on the deal. But in prediction markets, it's different. Unlike gambling, there is no house that is taking your bet. Instead, you're betting directly against your peers, and that's why prediction markets are considered peer-to-peer marketplaces. If you think about it, it's almost like a stock exchange. There are no odds set on the individual outcomes. Instead, the amount you can win is determined by the supply and demand of traders on each side of the outcome. So as we can see here, as more traders bet that the Fed will cut rates in October, the payout for that trade becomes smaller and smaller. If you had bought 100 contracts on September 1st when the chance of a rate cut was 48%, you could have spent $48 and received $100 if you were right. But now that more and more traders are agreeing that the rate cut is the most likely outcome, those 100 contracts have a 94% chance of being right, and they would cost you $96 today with the potential to get back $100. So your profit went from $52 to just $4. Not because the house or sports books changed the odds, but because your peers started coming to the same conclusion. And there is no VIG or margin built in for the house. The prediction markets instead take a commission or fee on the winnings, pretty similar to trading a stock. And just like trading a stock, you can buy and sell your position whenever you want. So if you bought in when the odds of the rate cut were 48% and have held through today at 94%, you could opt to just sell your position and take your profit now before the Fed actually comes to a decision. Unlike most traditional gambling games where you have to wait for the outcome of the event to occur before getting your money. But prediction markets are anything but new. Even though it seems like they've popped up out of nowhere over the last 5 years and minted the youngest billionaire on earth, they have been around for a while. If we go all the way back to the 16th century, markets were used to predict and bet on the election of the Pope in Italy, and in the 18th century, coffee houses in London served as exchanges to bet on political scandals and changes in Parliament, with these exchanges actually becoming the modern-day London Stock Exchange. And more recently, in the 19th and 20th centuries, US election odds were used as predictive tools in determining the outcome of upcoming elections, which is what brings us to the name itself. Why are these markets called prediction markets instead of gambling? Because you're basically betting on the outcome of an event. Well, that's where we need to consider the goal for each platform. In gambling, the goal is to entertain and profit from a favorable outcome. Like I mentioned earlier, sportsbooks don't set the odds as a way of predicting the outcome. They just set them in a way that will draw in as many bettors as possible. But in a prediction market, the goal is to collect information and forecast the likelihood of an event occurring. As the market price changes, we get a collective real-time forecast of an event's probability. It's almost like a hive mind with millions of data points coming together to create a prediction of what will happen. But sometimes that data isn't actually as reliable as you might think, but we'll get to that later. Let me introduce you to the two major players in the space, Kalshi and Polymarket. Although they both offer very similar markets to trade on, they are pretty different in the way that they operate. The biggest difference being which platform is legally allowed to operate in the United States. Since prediction markets aren't considered gambling, they are governed at the federal level by the Commodity Futures Trading Commission. And if you remember from earlier, trading on a prediction market is known as buying and selling contracts. These contracts are the glue to the entire argument that this is not all gambling. These contracts are considered financial derivatives, which are some of the most complex things to understand in financial markets. But at their core, a derivative is something that derives its value from another asset. When you buy a contract or a derivative, you're not actually buying that asset like a stock. You're instead paying for the ability to buy that asset in the future at a set price. So in the case of a prediction market, you're not actually trading on the outcome of the event itself, but you're trading on the value of the event's outcome. In prediction markets, that value is based on the probability of the future event actually happening, which means the value of the contract decreases as the event becomes more certain, or increases as the event becomes more uncertain, mainly because less people are willing to take the trade on an event that is unlikely to happen. So if you take the trade with the smallest probability of happening and you end up being right, you'll walk away as the biggest winner. In 2020, Kalshi received approval from the CFTC to operate as a designated contract market, or DCM. As a DCM, Kalshi is now able to create a contract on basically anything they see fit, as long as it isn't related to terrorism, assassination, war, gaming, or any other illegal events. But wait, if event contracts on gaming aren't allowed, then why did we place buy contracts on the outcome of the football game? Well, the word gaming in this context doesn't really have a definition, which is exactly what allows Kalshi to get away with setting up event contracts on basically anything they want, from elections to NBA games. The CEO of Kalshi was actually quoted saying, "I just don't really know what this has to do with gambling. If we are gambling, then I think you're basically calling the entire financial market gambling," which to some extent is correct. Trading on any stock at its purest form is betting on whether the price will go up or down. So I kind of see the point he's trying to make, but the states and the casinos operating within them aren't as happy with that explanation, which we'll touch on in a bit. But first, we should talk about Polymarket, the other big fish in the prediction market pool. You see, Polymarket is an interesting business. Unlike Kalshi, who operate as a federally regulated DCM, Polymarket is a decentralized blockchain-based exchange, which means they're not US-based and you can't transfer cash directly in like Kalshi. It's all based on crypto. With all that said, Polymarket has not been as successful in the judicial process as Kalshi. In 2022, the CFTC sued Polymarket for operating an illegal, unregistered derivatives trading platform in the US because they did not have the approval to operate as a DCM like Kalshi. That lawsuit was settled for $1.4 million, but the settlement required that Polymarket not allow US citizens to trade on the platform, which they didn't do too good of a job on. US users were just using VPNs to change their locations and continued betting. So in 2024, the FBI ended up raiding the CEO's apartment. At the moment, Polymarket is still banned from the US market, but some things might be changing. So if casinos are bad and sports betting is their ugly cousin, what does that make prediction markets? Are they the hot new thing on the street, or are they truly degeneracy at its finest? It kind of depends on how you look at it and your opinion on financial markets as a whole. My problem with it lies in the fact that it makes gambling extremely easy and extremely accessible. Since these event contracts are governed under federal futures trading laws, you only have to be 18 years old to place a bet, unlike gambling, which is 21 in most states. Additionally, you can't argue that these platforms don't drive the desire to gamble through the roof. We already know how detrimental gambling addiction can be, and as these platforms become more and more popular, they become more and more desired by everybody. So if you can get someone in the door with a quick bet on the Sunday night football game, then tease them with a quick side bet on how long they think the government shutdown's gonna last, you can slowly drag new bettors into a lifetime of regret and leave them placing bets on anything and everything. Not to mention, this opens the door for an insane amount of insider trading. I mean, just think about it. Every time Trump does a speech or press conference, there's an event contract open to place bets on specific words he might say. How hard would it be for one of the scriptwriters to just slip in the word China into the speech and make a quick buck? Or during these company earnings calls, if you saw the talking points beforehand, you could easily place a bet and win.
Yeah, I hope we answered your question on that. I was a little distracted because I was tracking the prediction market about what Coinbase will say on their next earnings call. And I just want to, add here the words Bitcoin, Ethereum, blockchain, staking, and Web3 to make sure we get those in before the end of the call.
Now, I understand that to an extent, insider trading is that easy when you have insider information. But with these platforms, the enforcement is much harder because a lot of the times they're not required to inform regulators of suspicious trades. For example, Kalshi isn't required to report any suspicious trades to the NBA, which leaves everybody in the dark on whether there is some form of insider trading or gaming of the system. That said, these legal issues are changing in real time. In fact, since I started working on this video a few weeks ago, a lot of the rules have been adjusted and a lot of big news came out. The biggest of which being a $2 billion investment in Polymarket by the Intercontinental Exchange, who is the parent company of the New York Stock Exchange. Now, why would the New York Stock Exchange invest in a company that's not even allowed to operate in the United States? Well, if I were a betting man, I would probably venture to guess that Polymarket will be live in the US by the end of the year. Outside of Polymarket and Kalshi, we've also seen some huge moves from other platforms. Specifically, Robinhood is getting very involved and now offer a full suite of sports betting and prediction market events, as well as the traditional gambling sites like DraftKings and FanDuel, both of which have recently acquired CFTC-approved prediction markets that they will be integrating into their current platforms, with the hopes of expanding their sports betting nationwide, even in the states they were previously not allowed to operate in. Which brings us back to the problem that states and casinos have with prediction markets. Traditionally, because gambling is governed by the states, they've had to abide by the different laws and regulations in each state. This includes paying taxes on gambling revenue and other specialty fees. But since prediction markets aren't gambling, they don't have to pay, which has led to countless lawsuits across the country led by state legislatures, gambling addiction funds, and Native American tribes, all alleging that these prediction markets are actually gambling companies and should be governed accordingly. But the prediction markets continue to argue that they are not sports betting or gambling websites.
Yeah, I mean, I think that these prediction markets are qualitatively different than sports gambling for a couple of reasons.
They feel that they are providing the public with a service by giving investors an increased view of public sentiment or allowing the public to get a better idea of future events. And allowing people to make money on them is just a side piece to the whole equation. They even argue that gambling on sports isn't even about the game itself. It's about the potential for economic opportunity if a given sports team wins. Because with a win, more people go to the next game, more people shop for jerseys, and the city will see an economic return. So your bet on the prediction is actually related to the economic outcome of the game, not the game itself. I'm not sure most of the people placing their bets see it that way, but if that's how they get around the regulations, so be it. This market is evolving faster than we can really keep up with, and things have changed drastically over the last couple weeks. The NHL just signed a deal with Polymarket and Kalshi. Sports parlays are now available on Kalshi. Robinhood continues to expand their sports betting offerings. and we just saw one of the largest sports betting scandals in recent history. So it'll be interesting to watch how this all develops and to figure out if there's a way to actually trade prediction markets like the stock market.